If you're buying a home, renewing a mortgage, or just reviewing your financial protection, there's one mistake a lot of Canadians make without even realizing it. They assume mortgage insurance and life insurance are basically the same thing, but they're not. And understanding the difference can have a major impact on how well your family is actually protected. Because on the surface, mortgage insurance can sound like the obvious choice. You're sitting with the lender, you're signing paperwork, and they offer insurance that will pay off the mortgage if something happens to you. It sounds simple, it sounds convenient, and for a lot of people, that's where the conversation ends. But this is where many Canadians get it wrong. Mortgage insurance is designed to protect the lender. Life insurance is designed to protect your family, and that distinction matters tremendously. With mortgage insurance, the benefit typically goes directly to the bank or lender to pay off the remaining balance on the mortgage. Your family doesn't receive that money. They don't get to decide how it should be used. Only the lender gets paid. With personal life insurance, your beneficiary receives the payout directly. That means your family can decide how the money should be used based on what they actually need most. Maybe they want to pay off the mortgage. Maybe they want to cover monthly bills, replace lost income, pay for childcare, reduce financial stress, or simply create breathing room during a very difficult time. That flexibility is one of the biggest differences. And there's another issue that a lot of people don't realize. With mortgage insurance, as you pay down your mortgage, the coverage usually goes down over time. But your premium may stay the same. So in many cases, you're paying roughly the same amount for less and less coverage as the years go on. That's very different from a personal life insurance policy. With term life insurance, for example, your coverage amount generally stays level for the length of the term. So if you buy a $500,000 policy, that full amount is there for your beneficiary if something happens during the policy term. That creates a very different kind of protection. Now, to be fair, mortgage insurance is easy to say yes to. It's offered right at the point of getting the mortgage, and it feels like one less thing to think about. But convenient is not always the same as better. Another thing worth understanding is how underwriting works. With many personal life insurance policies, you go through underwriting when you apply. That means the insurer assesses your health and approves the coverage upfront. With mortgage insurance, in many cases, the process can feel much lighter at the beginning, but the real assessment may happen later, at claim time. And that can come as a surprise to families who assumed everything was already settled. That's one reason why it's so important to understand exactly what you're buying, rather than just checking the box because it was offered during the mortgage process. Does that mean mortgage insurance is never useful? Not necessarily. But what it does mean is that many Canadians accept it without ever comparing it to other options, especially personal term life insurance, which may offer more flexibility, more control, and in many cases, better overall value. And this is where the right question becomes really important. The question is not just, will this pay off my mortgage? The better question is, if something happened to me, what would my family actually need? Because for most families, the mortgage is only one part of the picture. There are still monthly bills. There may be children to support. There may be income that needs to be replaced. There may be debts outside the mortgage. There may be education costs, childcare needs, or simply the need for financial stability while life gets reorganized. So if all the insurance does is pay off the mortgage, that may not fully solve the problem. That's why personal life insurance is often the more complete solution. It gives your family options. And when families are going through a difficult loss, options matter. This is also why working with an independent advisor can make such a difference. If you're only being shown one product in one moment, it's easy to assume that's the best fit. But the best fit depends on your goals, your budget, your family responsibilities, and what kind of protection you actually want in place. For some people, the conversation should be about covering the mortgage. For others, it should be about protecting income, covering multiple financial obligations, and making sure the family has flexibility, not just debt repayment. That's a very different planning conversation. So if you remember only one thing from this video, let it be this. Mortgage insurance protects the lender. Life insurance protects your family. And before you say yes to any coverage, make sure you understand who the policy is really designed to protect, how the benefit works, whether the coverage stays level, and whether your family would actually have the flexibility they need if something happened to you. Because what most Canadians get wrong is assuming these products are interchangeable. They're not. And making the right decision here can mean the difference between having some coverage and having the right coverage. If you have questions about whether your current mortgage insurance is the right fit, or whether personal life insurance would better protect your family, visit our website at www.policyninja.co and book a call with one of our insurance specialists. We'll help you compare your options, understand the differences clearly, and make sure your coverage actually fits your needs. And if you found this video helpful, be sure to subscribe to our YouTube channel. We share clear, practical guidance to help Canadians make smarter decisions around insurance, wealth protection, and long-term planning.